Now I'd like to introduce Guy Richardson, a partner at Moore Kingston Smith in London, to discuss global real estate investment trends and opportunities.
Thank you very much, Dan, and welcome to everybody to this webinar where I am joined by Paul Tostevin, who's a director from Savills World Research Department. And today we're going to take a little bit of a dive into world investment real estate trends and start to look at what has been happening in the market, what Savills are predicting to happen in the market, and give you some ideas about where you might want to be thinking about in the world in terms of investment opportunities in real estate. So thank you very much for joining us, Paul. If I could take a point to invite you to just say, do your own little introduction.
Yeah, delighted to be here, and yeah, great to be talking today. As you say, I'm director in Savills Global Research team, so we look at all global markets, all sectors, and the forces and factors shaping real estate. So lots to cover, and hopefully lots for us to talk about today.
Fantastic. So I think where we'll start is let's start with something that is a hot topic in the UK for various different reasons, and probably a hot topic around the world, and that's the residential market and where residential prices are going. So, Paul, you look at residential markets across the world regularly, talking to your clients, and obviously the world has seen the biggest shake-up it's seen in a number of decades with the COVID pandemic. How have you seen that shape buyer demand, what they're looking for in their homes, what they're looking for in location since the pandemic, and therefore what investors might need to be mindful of?
Yeah, I mean, certainly one of the big trends to emerge from the pandemic has been the huge home working experiment we've all been part of over the last 18 months. People have been spending a lot more time in their homes. They couldn't travel either, so their homes and the space in their homes matters much more than ever before. And you know, we've done some really interesting surveys actually of our global network to find out more about this. We ran a survey, for example, of European home buyers across France, Italy, Portugal, and Spain. And over a quarter of those respondents actually said home working had influenced their purchasing decision in some way. And just under 3/4 of those expected to work from home at least one day per week after the pandemic, up from only half prior to that. So it's really kind of shaping things in terms of what people are looking for in their properties.
So taking that, Paul, what are people actually really looking for in these homes then, now that they're thinking about home working as part of their purchasing decision?
Yeah, I mean, that's certainly, impacting things around amenities. High-speed internet, of course, really an essential now. And actually, funnily enough, a good view is probably important when you're sort of looking out from your home office. And outdoor space really matters as well, particularly sort of medium-sized spaces, balconies, patios, particularly important. And locations themselves are changing too. Rural locations are in much greater demand than they were. More than half of those looking for a main residence are planning to purchase in a rural environment, according to our surveys. Actually, if you look at those looking for second homes, that rises to 80%. But I would say, we shouldn't write off urban environments just yet. Only 37% of those under 40 were seeking a rural environment, and we can pick up sort of the city story later.
Okay, so bearing those things in mind, that desire for the amenities, that perhaps more idyllic living space and area, thinking about an investor's point of view, which world cities do you think are probably most attractive now to an investor based on those tenant requirements and desires?
Yeah, I think I think it's worth thinking about kind of world cities in particular and where they all fit in. In spite of all this talk of moving to the countryside, city residential markets actually performed really quite strongly during the pandemic. especially against the backdrop of a huge global economic downturn. And within my team, we monitor 30 world city residential markets, and across them all, on average, capital values declined only 0.3% in the first half of 2020, and actually rebounded in the second half of the year. And the falls we saw were much less severe than during the global financial crisis. And just showing a chart here, you can see that difference. And of course, that was a banking crisis. This one is very different, with some very different conditions. Rental markets have been a little different, a little less resilient. That we did see some falls in both parts of the year, and that's much more attributed to residents leaving cities in search of that space and green space as a result of lockdowns in many of our world cities. But yeah, I guess coming to your question, kind of locations in demand, what people are looking for. If we look at the strongest performing cities globally, well, first of all, interesting to see that over 2/3 of the cities in our index actually saw positive price growth in the second half of the year. And to give you a feel of where those cities fall on the spectrum, you've got everything from Hangzhou, which is actually an important Chinese tech city, growth of 4.5% in the last 6 months of last year. Paris, 0.8% price growth. I'll talk about that in a little bit. And Cape Town, actually, at the other extreme, seeing price falls of 3.2%, actually the lowest in our index, much more driven by kind of domestic market weakness there. As I say, I think the overarching story here is a domestic one. Usually a global city's prime market is actually driven by international demand, at least to some degree. That hasn't continued in the pandemic, so that's been a change, much more domestically driven.
So despite those changes in what people want, actually cities are not dead, and there's still growing markets in many cities in the world, depending on where you go, and it's probably more locally driven than those global drivers.
Absolutely, yeah, and if you look at kind of absolute value, and this again is quite interesting. So here a chart showing prices per square foot across different global cities, and interesting to see Hong Kong up there, by far the most expensive city globally, almost double that of New York. And most cities globally were looking at between sort of $1,000 and $2,000 per square foot. And if you're looking for actually opportunities, you look to kind of the right-hand side of that chart. So Dubai, Cape Town, Kuala Lumpur, comparatively more affordable by global standards. Good value in Europe, the likes of Lisbon, Madrid, Barcelona. So in an interesting spectrum there. And I suppose looking ahead, where everyone's particularly interested in sort of where things are headed, which cities are most in demand going forward. This map shows price growth for 2021, full year price growth. And obviously we're a little way into that now, but you can see Seoul actually stands out as the strongest performer, close to 10% price growth predicted, followed by Berlin and Sydney. Again, this is quite a domestic story. So Germany, relatively domestic market, offering a little bit more value. That's playing a bit of catch up. Seoul also, quite a domestic story. So actually, looking ahead, most of the cities that we monitor are expected to see stable or positive growth over the near term, and that bodes well for investors. And yeah, as you say, certainly far from the death of the city.
So I wonder if we could maybe just take a little bit of a deeper dive into some of those cities. And I've got two cities in mind, I think. One is the city that I'm planning to go on holiday to very soon, which is Monaco. And the other one, and I'm going to stay in the French area, is the city where my better half is from, Paris. Can you just tell us a little bit about those markets and what we're seeing as the trends there?
Yeah, two interesting markets actually, and I think both indicative of some broader global trends we're seeing. Monaco, starting there now, talked about the world's most expensive cities, of which Hong Kong is top. If you include the Principality of Monaco, Monaco is more expensive. Again, its prices here are 20% higher than those of Hong Kong, 180% more expensive than London. And why is it so expensive? Well, a lot of that comes down to size. It's incredibly land constrained. It's in size actually smaller than New York's Central Park, but it has a population of 38,000 people. But clearly it's a very attractive place to live. It offers coastal living on the Côte d'Azur, but with that favourable tax regime for residents. And then I guess just to kind of give a feel of the evolution of prices and transactions in Monaco, we actually saw modest price falls last year. But I think, again, given the wider uncertainty we saw globally, that's actually pretty remarkable. And actually prices have been at a really high plateau since 2018. And transactions saw a bit more of a dip. Some of that, I think, comes down to those travel restrictions that have been in place globally, so that, again, the market actually became more domestic, which was probably the overarching trend there.
So I thought I'd just do a little interjection there to move on to the next slide. So with that in mind, then, what's the outlook looking like for Monaco? A very small, concentrated and expensive place. What should investors be thinking about if they either already hold property in Monaco or thinking about investing in property in Monaco?
Yeah. Interesting question. I think important to sort of think further ahead. I think there is sustained interest in Monaco, and the restrictions over the last sort of 18 months have only led to, I think, greater pent up demand. So that's going to come through as soon as international travel opens up again. The big story though of Monaco is supply constraints. There is new builds coming through, but it's relatively limited. 3 smallish projects coming online this year and next, another in 2024. So that will help. And actually longer term, Monaco is also sort of embracing land reclamation. So that's going to also add to the sort of fundamental size of the place as well. And actually, the rental market's another interesting story. It's likely to benefit in the short term as that foreign demand travel returns, and we see more people kind of testing that market, and they kind of adjust to the lifestyle and try the place out. So I think in short, positive prospects, but some restrictions as well.
Very, very interested about that land reclamation point there, and the fact that actually, with such a small area, there's going to be potential opportunities for more properties to be put on there, and that does bring with it investment opportunities that people can get in with now, whilst it's still early days.
Yeah, and clearly, a hugely expensive thing to do, but in a place like Monaco, it does stack up because the kind of the value's there, the demand is there as well.
And so, what about Paris then? And Paris and London. I live in London, and as do you, Paul. They're quite close geographically, and they're obviously quite well connected through the Eurostar. How do they fare against each other? I'm quite interested to see.
Yeah, Paris is an interesting one because it is a kind of top tier world city. It's performed perhaps a little differently to some of its peers in recent years. It has some of those characteristics of limited supply, growing demand, and of course in this low interest rate environment we've seen demand rise. But if you look over the last sort of decade or two, and here I'm showing a chart that shows the performance of prime Paris residential property versus that of prime London as an index. And you can see, London seeing some pretty spectacular growth coming out of the financial crisis. That didn't really happen in Paris. You saw a bit of an uptick, but then we saw the election of Hollande, and a lot of kind of negative sentiment around sort of wealth and wealth taxation. And it really kind of lagged London for a period. And it wasn't really until we had the sort of Macron era and more kind of positive sentiment, at least in terms of inward investment, that really boosted that market. And of course, conversely, in London, we saw the likes of Brexit and various sort of stamp duty reforms somewhat dampening the market. So really interesting to see how these two cities that, like you say, are very well connected, and their sort of fates intertwined to some extent, have actually performed quite differently over the period.
But it does look like Paris and London are getting closer together. And my better half might be suggesting that maybe a move to Paris might be a good idea in the near future.
Yeah, possibly, and interesting to see how how things play out at a more micro level. So, as you might be familiar, that Paris is made up of 20 districts or arrondissements, and showing another chart here, you can see how price growth has performed in 2020 by arrondissement. And actually, it reflects those broader trends around the search for more space and people going to those outer districts where there's perhaps a little bit more room, a bit more property for your money. And actually, the 2 to 3 bed market's been particularly strong. Actually, as indeed have pied-à-terres, which kind of fits with that idea of people keeping that Paris bolt hole, but also the place out of the city for spending time as well.
That sounds very reflective of what's been happening in London as well, with the outer boroughs seeing a lot of activity as people want to still remain relatively close into London and have a relatively short commute, but take advantage of being slightly closer to nature and the green belt.
Yeah, you're exactly right. I mean, we're seeing the same thing in a lot of Western cities, New York as well. So it's a trend the world over. Interesting, actually, though, looking at the best performing area of Paris last year was actually the 5th arrondissement, which is an area actually very popular with families and has lots of very well regarded schools. So there are some sort of fundamentals that still hold true. So 8.5% growth there last year specifically.
And so what's Paris's biggest challenge then, from a residential property point of view?
Yeah, so I suppose one of the challenges Paris has had for a long time, it has as you know, it's a dense historic core where a lot of kind of the investment and economic activity has been focused. And I think one of the challenges that it's grappled with is linking in its outer areas and its outer suburbs. And they've introduced the Grand Paris sort of infrastructure initiative, which will add 2 new metro lines, extend 4 other metro lines, actually add 68 new stations, with the aim to really kind of link up those outer suburbs and indeed the suburbs to the centre of Paris. And that could be quite transformational in terms of really boosting those outer areas, and it comes at that really kind of opportune moment as people do, like we're saying, are looking for that extra space, more space in their property, a better value for money. So some interesting things to come, I think, from Paris.
Well, very interesting indeed. We could see Paris, as London is no longer in the EU, potentially taking over some of that functionality and expanding, and we might see trends that we see in London in Paris in the near future. So that's something to maybe watch. Could we move on to sort of looking at the yields of residential property, given that investors, obviously, they're looking for yield. Capital is important, but what you get as return is even more so important. And also, I'm quite interested to know about the costs of holding property in each of these, in each different city in the world, because there's big variations between how costly it is to hold and sell and buy property. In London, we've got stamp duty, we've then got income taxes on rents, and then we've got capital gains tax on exit. How does that compare in world cities that you're monitoring?
Yeah, I mean, this really kind of gets to the crux of that sort of investor question, doesn't it, and returns and costs. So yields is a good place to start, and I think it kind of gives a feel for overall gross returns across different cities. So showing another chart here, this is average gross prime yields across the cities that we monitor globally. So this doesn't include some of those extra taxes. But you can see, for example, US cities generally high yielding, typically quite strong rental cities. Historically, capital markets have lagged a little bit, although that is changing. And then, other higher yielding cities in Europe, Amsterdam, Barcelona, interesting one. But I think the big story actually is on the right hand of the chart, and which is the Asian cities, particularly Chinese cities, which have seen a period of really spectacular capital value growth, huge domestic investment into the residential markets of China, seen as a real safe store of wealth, and that's really served to bring down yields as rents haven't really kept pace with that. But yeah, I mean, as you say, that's only part of the story. There's a whole host of other costs associated with it, and what we've tried to do here is look at the cost of buying, holding, and selling property in these cities around the world. It's quite a specific scenario. It's $2 million property. We assume a non-resident overseas buyer. It's a second home, so there's again certain taxes associated with that. But a couple of interesting takeaways: Hong Kong, Singapore, right up there. Huge additional costs for foreign buyers in particular, and that's been something that's actively been chosen by the government to try and cool those quite expensive markets. Then you see that the likes of London, middle of the pack, an extra 12% on the purchase price, wrapped up with in additional ownership costs. A lot of that's again attributed to stamp duties on purchase. But if you factor in things like the holding costs, actually London's quite low by global standards, given the fact the only sort of main holding cost from a property perspective is council tax. So it does vary, and as I say, it also varies depending on your specific scenario. But interesting to kind of get that feel for the spectrum.
So I'd like to just touch on something you mentioned. You've got in your yields table, you've got Los Angeles, and as you know, some of the American cities right up there on the left, and they're also on the left of the capital returns in thing as well. So the capital is growing and quite robust. The yields are pretty high. And then when we look at the cost of holding, we see that a lot of those US-based cities, the actual cost of buying is quite low, relatively speaking. It's the costs of holding and selling that are quite high. So if you're a long-term investor, it sounds like that's potentially an attractive proposition to invest in US property. Or is there something else at play here?
I think there is a solid case for it. I mean, obviously, it depends partly on the outlook from here. Clearly, they've had quite a strong run. I think there's also something around kind of diversity of demand. The US does still remain mainly domestic in its demand base, although it certainly is international at the top end. Whereas if you look at somewhere like London, which has an incredibly diverse international demand base, it's probably one of the few cities that globally that gets buyers from literally every corner of the world, which is positive in terms of longer term demand. But I think there's been a bit of a story of kind of catch up with the US over the last couple of years actually. So that's probably partly what we're seeing coming through in those figures.
It's interesting that you made that comparison. You look at London and the trend is reversed. The buying costs are quite high, and the occupancy and the selling costs are comparatively low. It's a complete role reversal of the US, which is perhaps reflective of the fact that if you've got quite a lot of foreign investment coming into London, they would like, the government would quite like the transaction costs, whereas if you've got a domestic market in the US, it's all about the hold costs.
Yes, you're right, and some of the additional stamp duties on foreign buyers have been a response to that. Obviously, we've had more of those added into London, and you look at extreme examples like Hong Kong and Singapore, and you can see the scale of some of those stamp duties as well. Although from our experience, they don't tend to really slow demand. If that demand is there, it will come.
Thank you very much, Paul. That was a good insight into the residential markets across the globe. and hopefully it's given some insight to the audience as to where they might want to think about putting their money if they are a residential investor looking overseas. So, Paul, I'd like to move on to the commercial market prospects now. We've just been talking about world cities and residential markets. For anybody who hasn't seen that bit, please go back and have a look at it. Let's take what we've learned from those residential markets and what people want in terms of where they live, and consider what impact that's had in terms of businesses and commercial property. And I'm interested to hear what you think and what your research is telling you about the impact of the pandemic on commercial markets. What are the assets that have been top performers and that investors have been interested in? And what are they steering clear of as an asset class?
Yeah, so lots to say about the commercial markets, and I think actually a really interesting place to start is, funnily enough, looking at the past. Now, clearly, the circumstances of the economic downturn we've just seen are unique in modern times, at least. But I think it's interesting to look back at past market cycles to kind of learn from the past and see what might happen in the future. And actually, immediately after the last 3 global recessions, we saw a sharp rise in investment into core assets, which are perceived as safer. And that trend is playing out again this time already. So far this year, we've seen 71% of global investment into core income-producing assets. What are they? Well, historically, they've been CBD offices. And these do remain the largest and most liquid part of the real estate market. But I think there's question this time over whether they are quite as core as they once were. And we can pick that up in a bit.
And just to be clear, well, when we say CBD offices, we mean central business district offices, don't we? So we're talking major towns, major cities across the world.
Absolutely, yeah, and places where there's a strong kind of occupier demand base to sustain those assets as well. That's right. Yeah, and past cycles have given us clues, but as I say, this wasn't a normal downturn. And the question is, will things be different this time? And certainly the government response to the pandemic's been unprecedented in terms of fiscal and monetary support. And that's only served to make real estate look even really good value compared to other asset classes. But one of the big things that's different this time is that some sectors are emerging stronger from the crisis, really kind of riding that wave of technological and social change. And that kind of means looking at sectors of the future. So science and research focused assets, data centers, of course, and anything that's ESG compliant, so environmental, social, governance related criteria, assets that meet those sort of basic demands.
ESG is an interesting one because it was very much coming onto the agenda in 2020 and then kind of got parked because of COVID, and is now very much back on the agenda for 2021. Everybody who's making a business decision now about where they're going to put their business, these are the considerations that are making it onto the table. And certainly with my clients, I'm seeing it play out as to how they shape their developments, and what they look at in terms of their acquisitions, and what businesses look for as an occupier, and they can be the differentiating factors. So it's a very important thing for investors to be thinking about, because those that don't update their assets, make sure that they're as compliant as they can be with what they've got, they can find themselves falling behind on the trends.
For sure, and yeah, the fact that real estate accounts for 40% of global carbon emissions, really kind of brings home the significance of real estate in that equation as well.
And taking those sort of factors and what are those attractive opportunities in terms of asset class, where are you seeing investors putting their money over the next year?
Yeah, so of course, a lot of talk around beds and sheds, so residential and industrial or logistics. The latter, of course, really sort of supercharged by that huge shift we've seen online during the pandemic. But actually, we've done some work with our global network looking at sort of prospects for the coming year. And based on our survey of different global cities, that the dominant asset class for investment actually next year is still going to be offices. And I think that's really testament to the role of offices as a place to collaborate and instill company culture, etc. And that filters through to the sort of investment ideals as well. So that's not going to go away. Logistics certainly really important, as indeed is institutionally invested residential, particularly in North America, which is already the largest market globally for investable products in that space.
And so, given that, where do you see yields going then between those asset classes that you've just identified, office, logistics, and residential, that investors need to be thinking about?
Yeah, so office is really showing remarkable resilience. Again, from an investor perspective, 97% of our survey respondents expect to see office yields either remain static or fall over the 12 months to the second quarter of next year. And that shows that the resilience of that sector. Logistics or industrial and residential, we're expecting to see in majority of cases yields move in, reflecting that increased investor interest in beds and sheds. I guess picking up retail, interesting one, because we've seen industrial yields move in to the point where they're actually almost on par with retail yields in many markets. But if you look at the likes of Asia, some key Asian cities, Tokyo, Singapore, Shanghai, we've seen retail yields continue to move in actually, and the demand for residential has remained, and that really reflects the role of residential in Asian society actually more broadly. It's a place not only to shop, but it's an important kind of leisure and even community facility. And that's going to sustain that sector, particularly in Asia. But I'd say actually globally, there's still real potential for retail, particularly as those assets are kind of reimagined and repurposed to meet modern day consumer needs and wants as well.
It's definitely a challenging market, isn't it? And I think it's one not for the faint-hearted. There's a fair bit of risk in the retail sector in that asset class. But those that can get it right and those that can do that reshaping of how those assets are operated before can potentially see big returns as they get into a space that is probably going to become more narrow as the future goes on.
Indeed, yes, it's picking the options, and certainly with some of the repricing we've seen, there are opportunities out there, but it does require a bit of expertise as well.
And can we just touch a bit on that office forecast there? Because I think a lot of people find that quite surprising, given that we're all talking about hybrid working. Many of us have been working from home that have office jobs rather successfully. And there's certainly a lot of talk about reshaping the office space. To see that resilience is probably counter to what many would expect. Where do you see that's coming from, and how do you see the market developing over the next few years?
Yeah, as you said, it's the question on everyone's lips. It has been kind of the ultimate homeworking experiment for much of us in the last period, and yeah, question is that going to continue? I think a big way to look at that is what occupiers are saying, and we're just beginning to see some announcements or indeed sentiment from big global office occupiers about their future intentions. And there's a real spectrum actually. So showing a chart here which looks at some of those intentions or sentiment on hybrid working from some of these global occupiers. And what we've actually done is put them on a spectrum from those that have said they're going to go back to full-time office working through to those that are planning to embrace more of a hybrid model. Actually, starting with tech, which you might think would have been the one group that would really kind of embrace hybrid working or home working. Actually, no, the office remains very much at the heart of their kind of future operations. We're hearing that tech occupies a leading leasing activity as well. So that's interesting, but there is a spectrum, and that announcements range from the likes of Facebook, which expects up to half of all its global employees to be working remotely in the next 5 to 10 years, through to the likes of Netflix and Amazon, who are saying actually we expect most of our employees to be back at their desks by the end of the year. So a big spectrum there. And similar from what we might call traditional economy occupiers. So particularly actually some of those financial services firms, much more wed to the office. But I would say hybrid working is here to stay in some form. And it's something that office occupiers need to manage now rather than later. And that actually probably has an impact on the type of space they might be looking for as well.
I think you're right there. I mean, the spectrum that you've got there, it does suggest that hybrid working is still going to be in play, even though you have got many players who are, to want of a better phrase, rejecting hybrid working, which perhaps opens up the pool of potential ways in which occupiers want to use a space, meaning that actually the office space does need to have that degree of flexibility so that you can accommodate a variety of different tenants. Or you go the other way and you make sure that you target a particular niche or a particular end of the scale and provide to that side of the market. So there are various different opportunities that the owners can look to there as to where they want to position themselves. I'm interested to know, are you seeing any kind of trends across the globe in terms of demographics or in terms of locales that have different attitudes to this particular part of the equation?
We are, yeah. So I guess what I just said out there is kind of the Western story. If you look to Asia, particularly China, clearly the pandemic was much shorter, very short lockdowns in China, if at all. People have just gone straight back to the office. There isn't really the home working debate at all. So that hasn't really changed there, although funnily enough, places like Shanghai, there is still the debate around the future of office locations, but it's much more about kind of decentralizing from the core because it's such a sort of big and congested city. But yeah, things are playing out differently in different parts of the world.
Indeed. And so we've talked a lot about the core commercial asset classes. What about the assets that are perhaps on the fringe there, that are not part of the core? What are you seeing as being the attractive propositions? So
beds and sheds were the buzzwords and have been for a while, which is residential and logistics. But we can expand that now to meds, beds and sheds. Those are the hot terms, and meds, of course, being anything kind of medical related. And again, this is something that's really been accelerated by the pandemic. Huge emphasis now on health and well-being, and that's really boosted life sciences in particular. What's really interesting about life sciences is that it targets certain locations, certain knowledge-intensive cities, so the likes of Boston, Philadelphia in the States, Oxford and Cambridge in the UK, of course. And as this sector is growing, we're actually seeing a whole new tier of locations emerging. So locations as diverse as Stevenage in the UK, Barcelona in Spain, Wuxi in China. So huge variation, huge opportunities as well, I think, in that space. And when I talk about meds, that also extends to healthcare in general. And that's another interesting, obviously very topical sector, and one actually where technology is really revolutionizing delivery, particularly in regard to sort of diagnostics, remote diagnostics, consultations, etc. And that has implications for the type of space needed as well.
Indeed, the healthcare sector has its specific requirements for the space that it uses. That means that you need to be quite tailored in terms of those asset classes coming for that functionality, and that in itself can bring risk if the asset doesn't quite perform as well as you're hoping. You might end up with an asset that's not really fit for repurpose into other things. So an opportunity, but one to be done carefully for in case things go wrong.
Definitely much more specialist indeed.
So you mentioned tech and life sciences in that last piece there. Where are you seeing the hotspots, let's say, in terms of cities around the world that are tech cities, if you like?
Yeah, so tech is hugely important because it's a big driver of occupier demand across all sorts of assets, and we do a lot of work in this space looking at where the capital is going, particularly actually venture capital, because it's a really good lead indicator of that demand for property and ultimately sort of people and places as well. And a decade ago, 73% of all global VC was invested into the US. Last year, that had actually shifted, and with the overall market vastly expanded, the US global share stood at 46%. So the US hadn't shrunk, rather the cake had grown overall, and it was divided between more places. And a big chunk of that had actually gone to China. So showing a chart here which shows VC investment into different cities around the world, top cities globally, and also the ranking from the most recent period. And you can see how that's very much dominated by the US and China, but it isn't the US at the top, it's actually Beijing. And there is one non-US or Chinese city, that's London, the number one in Europe, and certainly the standout in that region, and really kind of testament to London as a tech centre. And of course, can't talk about tech without talking about Silicon Valley. And again, looking at this chart, I think what's really interesting is that Silicon Valley isn't a city, it's quite a sprawling region that runs from just south of San Francisco down to the city of San Jose. So not a city in a traditional sense, but still very important. And actually, funnily enough, one that's kind of seeing new relevance, particularly as people look again to the suburban locations. So there's a kind of nice sort of circular story coming through there as well.
Very interesting. It still shows, though, that there's a big concentration of where those cities are at the moment. The US, China, and then all you've really got is a European contingent there to make up the numbers. So there's a big concentration in these areas for tech cities. You mentioned that there's other cities coming up, a second tier. Whereabouts are you seeing those cities arise? And are they in different locations to where we're seeing the core at the moment?
Yeah, so you allude to that core, and yes, it is concentrated in a number of kind of big cities, big global cities, frankly. But there is a really interesting push of smaller cities that are, anchored by usually strong educational institutions that are generating talented young professionals. There are, again, some global concentrations. So if we look at the US, you've got the likes of Boston, places like Austin in Texas, San Diego, Seattle, places as diverse as actually Cape Town, Tel Aviv. But if we're thinking of smaller cities, Europe really does dominate again. So talk about Eindhoven, Berlin, Basel, Barcelona. These are smaller cities by global standards, but they offer a lot of the things that particularly young professionals are looking for. Slightly more affordable locations, good access to green space, perhaps outdoor pursuits, but still not kind of giving up that city buzz. So these cities really tick those boxes. And actually, they're usually less polluted than those big city counterparts. So something quite timely. The gap here, though, is Asia, and it's not that they're not here. It's just concentrated in those big Asian mega cities in that case.
So it's interesting to see that Europe seems to be really developing itself into a tech hotspot to compete with the US and China. The US developing and expanding its offering there. And even there we can see Cape Town, Tel Aviv, so there are some additional players coming out into the globe. And this is perhaps an area where some of the more further field cities can make some inroads, and those that get in early may be able to see some good returns off the back of that. Yeah,
and it's all about those kind of vibrant, livable cities. A lot of these are actually on the coast as well, so it's lifestyle, and they're linked to industries like tech, which is quite footloose, really. So if you've got the people and you've got connectivity, you can almost go anywhere. So interesting one to watch.
So the commercial space is still very much a good proposition for investment, and even the offices. As much as we might like to think that home working has taken the guts out of the office market, that doesn't seem to be the case, and it still seems to be a very viable asset for people to invest in, perhaps just done correctly and done with flexibility and done with a bit of ESG thrown in there at the same time. Now we're going to take a little bit of a focus on cities. Much of the impact of the pandemic has perhaps brought into question as to what we really want from our cities and whether or not they are as relevant in the modern day, when many of our jobs, which are often computer-based, demand us being connected to the internet, mean that we can largely work from anywhere to one degree or other. So, Paul, based on the conversations you're having with clients and the research you're doing, are cities relevant anymore?
I think, in short, they are. They are fundamentally centres of collaboration, innovation, prosperity, which sounds like a lot of buzzwords, but we just have to look at the data. Cities account for 80% of global GDP, and actually that's forecast to rise to 90% by 2030. And they thrived and innovated over many, many hundreds of years, and they just need to continue to do that. And particularly given the pandemic, they need to become greener, more livable, and more affordable.
And so we've seen in our earlier conversations about the fact that some cities have performed comparatively well over the last year, and others not so well. Some have been resilient, and others not so much. What do you see as being the key qualities of a resilient city that's going to offer up a good investment opportunity?
So we've done lots of work around this, actually. We've developed a Resilient Cities Index, which actually ranks 500 cities globally. We look at 33 different metrics and put them into 4 distinct categories to really home in on what makes a resilient city. So this is everything from economic strength, knowledge economy, and technology. Big thread around ESG, so environmental, social, and governance, and the quantum of real estate investment into those markets as well. So when we've analysed all those categories, the top 5 cities globally are New York, LA, London, Tokyo, and San Francisco. Now, arguably no surprises there, all big, successful world cities. I think what's interesting, though, is if you start to look a little further down the top of our list at the top 20 globally, again, a really big concentration in North America and indeed Europe, just 2 in Asia, Tokyo and Seoul. And the reason we don't see many Asian cities there is because they tend to fall down on that ESG criteria. Interesting.
So the Western world is getting in on the programme with the ESG. And of course, obviously, the Western world are providing a lot of this capital in the first place, and therefore the trends of the investor, what the investor's looking for, are that much more closely aligned to what the provider, the asset developers are producing. So it's maybe a lag, do you think, or do you think there's a fundamental difference in how the East see things?
I think it's a lag. I think there will be a period of catch up, and as you say, a lot of it is driven by the investors. They have their own ESG criteria, and if they can't meet that criteria, they won't invest. So that's a pretty powerful incentive in itself.
And so when you overlay that with sort of populations in those cities, they're obviously quite big cities in general. How do you see that influencing those trends that you found?
Yeah, so looking here at our top cities, I've shown them here by size of population. So the top cities are big mega cities, but what's interesting is you are seeing some smaller cities come through. So the likes of Munich, Frankfurt, and Amsterdam, and they're really pushing through on that ESG criteria. So yes, Europe really leading the way there. But I was going to say, in terms of kind of quantum of some of these cities, it's quite useful to look at real estate investment. So this here we're looking at the biggest cities over the 12 months to March, and how volumes compared with the previous year. And you can see generally, yes, we did see a significant fall in investment volumes. LA, the largest market, followed by New York, Paris actually just ahead of London now as well. And interesting too to look at how international some of those markets are, and that's when you see the likes of London really stand out, the most international of those markets globally.
So we seem to keep bringing up that word, or that acronym ESG, that keeps coming back onto the agenda as being a key driver of where cities are looking very attractive and performing well. Can you talk to us a little bit more about some of those ESG factors that you're seeing across the globe and how different countries are comparing against each other?
Huge topic, absolutely. And some are saying 2019 was the year that the world woke up to climate change. 2020 was probably the year when they started to do something about it, and it's become hugely topical, particularly important to the real estate industry. And just looking at different factors, a lot of them are on a country level. If you're looking at some of those pure metrics, and picking actually just one here, which is renewable energy usage. Interesting to see Uruguay tops that list by that measure. 100% of all electricity here from renewable energy sources, mostly from hydro. And actually, it's a relatively recent achievement for them. They started on that journey 20 years ago. Over that time, they've actually managed to cut their greenhouse gas emissions by a pretty impressive 88%. And it's a really good example of what can be achieved. And it isn't just what cities are doing to reduce their contribution to climate change. It's also the impact that climate change will have on a city. And you've just got to think about the headlines over the last couple of years. So wildfires in California, as you can see here, wildfires in Australia, snowstorms in Texas, monsoon floods in Indonesia. The pace of the challenge is only increasing.
Indeed, really interesting to see that Uruguay is 100% renewable energy, and Norway is not far behind it as well. That I didn't know those facts at all, and that's quite an interesting thing there. Interesting that Uruguay hasn't really featured at all in any of our discussions so far. Do you think that's a player that could come onto the scene, or is this particular factor, it's a nice thing to say, but actually from an investment proposition point of view, it doesn't necessarily make it any better?
I think it kind of comes back to what we were saying earlier about locations earlier on the curve. And if places like Uruguay are already ahead of the game in some of that ESG fundamentals, that puts them in a stronger position going forward, and it does make that market look more attractive. But yes, as a sort of an investment market of scale, it's still very small by global standards.
But I suppose bringing in the what we talked about in terms of tech cities, and in the looking at the commercial side of stuff, Norway, which is obviously in that European zone, and Canada, which is in the North American zone, those high levels of renewable energy uses actually might become quite useful to those countries in terms of making them very attractive for investments.
And Norway, really fascinating, big leader in electric vehicles, sort of biggest market in Europe as a proportion of car sales. So it's markets that kind of can sort of push ahead and innovate. I think have some really interesting, exciting prospects.
A very interesting place, Norway, in terms of obviously they've had North Sea oil to rely on, and really boosted the country from what really wasn't as successful as it is today. And they seem to have used that money very, very wisely by comparison to some other countries who have had the oil wealth. And it's very pleasing to see that actually they're not reliant on that North Sea oil, at least for their own energy usage. And we can see how that plays out as a global country in the future. And going back to those physical risks from climate change, How do you see that manifesting itself in investment options throughout the globe?
Yeah, so I suppose the challenge here is that many global cities are now actually at risk from a physical risk from climate change, particularly the coastal ones, those exposed to increases in sea levels or storm activity and flooding. So for investors, it means understanding how physical risk might impact their assets' liquidity, its rental growth, and also its insurability. And that can also have an impact on the attractiveness of cities for investors. So many have already started to extend their due diligence to cities and how they'll lead on climate change adaptation as well.
And which cities do you think are particularly worth taking a look at with those ESG and climate change risks in play?
So lots of examples around the world. Picking just a few, Rotterdam's a really interesting one. It's a city that's been protecting itself from floods since the first dam was built in the 13th century. But it's a city that gets lots of rain. So they've actually developed these things called water squares, which I'm showing a picture of here. And they can be used to collect rainwater, but when they're not needed, they can also be used for things like basketball or volleyball or skateboarding. So kind of great multi-use facilities there. Tokyo, another really interesting one, city very much used to extreme weather. And to collect excess water, they've actually developed these giant underground tunnels where water is stored and then it's pumped into rivers at a later date. And actually, another interesting example from Seville, which isn't actually a physical risk, but they're using the oranges that grow alongside their roads, the ones that fall to the ground, to make clean energy. So kind of a really clever use of a waste product there. So I guess it all kind of comes back to innovation, really.
Yeah, that word innovation, what's coming to mind for myself as well. There's lots of different factors at play here when we're considering these different cities. As you've said, cities still very relevant, and they are still an area that people are going to want to live and work in. We've seen that the big core cities that have performed well in the past, we're still expecting to perform well going forward, with a few of the smaller cities coming up there. But clearly, the environmental side of things, both in terms of the quality of the assets themselves and relative to ESG criteria, but also those risk profiles of where they are located and what actions the local area are doing to mitigate those risks, need to be really taken into account when investors are thinking about where they might be putting significant pots of money into such assets in these cities. So thank you very much, Paul, for taking the time to talk to us today about residential markets, commercial markets, and global cities. Just like to take an opportunity to talk through with you those key takeaways that we think are relevant from those discussions. So if you could talk us through what you think are the key takeaways.
Yeah, so emerging from this recession, real estate demand's bouncing back fast, but there's a lot of money chasing the same things. And I bring it back to fast growing sectors and niches. So particularly those driven by knowledge industries, such as life sciences, but those specialist sectors do require certain expertise. And really critical thing is the ESG agenda, and that's kind of meant there's a general flight to best in class, and that's driven as much by occupier demand as investor ones. And ESG compliant buildings of all types are really now essential rather than just a nice to have. Indeed. So it feels like these are factors that have been on the agenda for a while now, and the pace has just increased. And we're heading into a world where these ESG factors now are really at the core of what investors need to be thinking about, and indeed developers when they're producing these assets. That's right, and it's not just the asset level; it's the city level. Cities need to evolve. Their success can't now just be measured on economic strength and demographics alone. I think being prepared to combat climate change is really essential now as well.
Indeed. A lot of those investment decisions are going to be driven by what the city and the country itself are doing in that ESG environment, what they're facilitating, and whether they're managing the risks of their particular location. And we did talk about earlier about resilient cities, which presumably are going to end up being quite an attractive proposition for investors that want to put their money somewhere where it's going to be safe. So combating climate change is clearly going to be a key factor in those decision making. Thank you very much, Paul. I think that was a good sum up of what our findings are. Clearly, ESG is probably one of the biggest things that investors need to be thinking about as they look for their global investment opportunities. Thank you very much.